Hi, good evening, and welcome to everybody again for our November edition of our webinar series. Once again, we are very pleased to have this sponsored by Barclays, and thanks very much to them. And we're joined by Adam White, who's the head of agriculture at Barclays this evening. I hope everybody is ready for learning how to plan their business in the new farming environment. Adam has just highlighted he's got quite a range of topics to cover in an hour, so we could probably do a webinar on each of them of a lot longer than an hour. But I hope you will find this useful. We're also joined this evening by Debbie Airy, who some of you will know and has attended one or two of these before for us, who's the head of agricultural practice at GRP Insurance, who are our insurance partners. As you will know, and so Debbie's going to talk to us a little bit about how we might know whether we've got the right level of insurance, and I guess maybe focus a little bit on maybe what impact COVID has had on this, and certainly perhaps very pertinently on what impact the increase in cost of machinery might have, and whether we've actually got enough cover these days. So we're pretty much at 7. So hopefully those who sign up are with us now. So welcome to everybody. Just a few bits of admin, as always. All of our virtual events are recorded and edited, and they're available on the TFA YouTube channel and also within the news section of the TFA. So anybody who wants to watch this back, or wants to even recommend it to somebody else who can't perhaps attend this evening, or is unable to watch it, the full version, and wants to come and watch it again, those are the places to go to. And as always, we've got a few questions that have been pre-submitted for later in the webinar, but there is an opportunity at the bottom of your screen, or certainly the bottom of my screen, there's a Q&A box. If you want to put any questions that come up for either Debbie or Adam, then please do so, and we will endeavour to get through as many of those questions as we can, and any that we don't pick up, and experience tells me we don't pick up all of them, we will endeavour to pick up with Adam and or Debbie after the event, and we'll come back to you and post those on the member section of our website. So you can please use that Q&A button if things come to mind. So I think probably without any further ado, we'll kind of crack on. So just to introduce, shortly we'll hear from Debbie Airy. Just to introduce Adam, who's our main speaker for the evening. Adam White is the head of agriculture for Barclays Business. He's responsible for a team of dedicated agriculture and landed estates managers right across the UK, and supports businesses through a range of projects such as diversification, sustainability, and obviously business growth. He studied at the University of Greenwich, followed by an MBA at the University of Lincoln, and he's also a fellow of the Institute of Sales Management and a member of the Institute of Agricultural Management. So he should be able to tell us quite a bit about business planning in the new environment, I'm hoping. He's worked with a wide range of SMEs at Barclays over the last 12 years, from startup businesses in their infancies to multinationals and anything in between. He lives in Cambridgeshire with his wife and his 10-year-old daughter, and in normal times, often travelling to China and other countries to explore and visit family. So we've got a bit of a rounded history of Adam tonight. He will be talking around what's the outlook for profitability for the main sectors of agriculture in 2022. What are the major cost issues to be concerned about in the medium term, and how do we keep a lid on them and control them? What's the likely attitude of banks towards short-term and long-term borrowing in the agricultural sector, with tenants obviously in particular in the current climate? What the bank and Adam himself considers to be the main characteristics of resilient businesses within the agricultural sector, and what are the potholes that farm businesses should be looking out for, and how they can plan to avoid them. So as I say, Adam's got quite a lot to get through tonight, and I'm sure there'll be a lot of questions that he raises. But first of all, I'm pleased to have Debbie Airy. As I say, some of you will know Debbie from previous webinars and the business we do with GRP. She's the head of agricultural practices at the GRP Insurance Group, and they look to support the sector and offer a credible alternative to major players in the market. She is a farmer's daughter and has worked within the insurance industry for over 37 years. She started her own brokerage in April 2007 with a specialism within agriculture. So with the farming connection and that experience, very well placed to understand what the farming industry needs from their insurance brokers. So as I said, tonight, she's going to give an overview of the current market and also include something which regards to the increase in rebuild costs and looking at sums insured on current farm insurance policies, with particular emphasis on whether we've actually got enough cover. So without further ado, we'll head off to listen to Debbie. So welcome, Debbie, and thanks for coming.
Good evening. Thank you, Mark. Thanks for that introduction. So I think I have spoke on a couple of these before, and I want to make it sort of, I know insurance is not everybody's favourite subject, and obviously Adam's got more interesting things to say than I have. But I think at the moment we just really wanted to highlight, make everybody just be aware, think about their insurance. Is your insurance cover enough for your actual needs? With COVID over the last 12, 18 months, a lot of brokers haven't been doing farm visits. You know, we weren't allowed at some stages to do farm visits. We were very lucky at CCIB, where I actually head up, and also Barclays in Worcester, which I head up that brokerage there, where we had long-standing relationships with long-standing clients. So, you know, we did a lot over the phone and virtually. However, you know, we are getting back out there now. We are going to see our clients. Some brokers, we are finding that they're actually using this as an excuse. You know, we haven't been for a visit for a couple of years and we'll carry on doing that. Actually, I think particularly in the farming market, I genuinely think people need a visit. You need to review your insurance. You know, the importance of an annual review can't be understated. A lot of people will receive the documents and probably put them in a drawer, not go through them, not actually look at the covers, and things have changed. People have done diversification. Insurers, capacity providers have changed. So there'll be endorsements hidden in those policies that you're not aware of. Biomass boilers, we have real big problems with biomass boilers over with fires and different things. So there is endorsements written into policies because insurers are really anti them. There'll be maintenance contracts, annual maintenance contracts that you'll have to have. So if you have a fire and you haven't done your annual maintenance contract, that's the first escape for an insurance company. So we need to really understand the endorsements that are written on a policy and make sure that you're not excluded. One that I think is a real funny one is a chimney sweep warranty. That, you know, it's on there that you have to have your chimneys. If you've got an open fire, which a lot of farmhouses do, you have to have a chimney sweep done by a professional chimney sweep. Now, I know many farmers are resourceful that could actually do it themselves and have the experience to do that chimney sweep. But we had, not one of my clients, thankfully, but they had a chimney fire, set the house on fire, and insurance companies riddled out. So it's the importance of reading those documents, making sure you understand them. In the last 2 years, what we're saying is rebuild costs have increased by 25%. Now, I know with tenant farmers, you probably, your landlord insures the building, or sometimes the landlord will make you responsible. However, if you have put a building up that you're responsible for and it's yours on the tenanted farm, make sure that those sums insured are adequate. And obviously, sometimes on the tenancy agreement, over a period of time, it'll be the landlord's responsibility. So you don't want to be paying for that insurance twice, you know, if it's moved on to the landlord's policy and you're still paying it. So that's the importance of a review, and where people can go around and just that general conversation. And when we're sitting there with people, things happen. Now, I know the importance now also of diversification, because some standard farming practices will not make enough money. So people have diversified in other areas and been really resourceful to get their income up. Just make sure that those diversifications are noted on your policy and discussed with whoever your provider is. And so you've got the cover in place to protect you. And then going back to the average clause, I think I've explained this before, but it's sort of the biggest thing that really annoys insurance. And I'll do it in a basic. So if you've underinsured, for example, you've got £10,000 of grain, and there's been a fire or an incident or a flood in there, if you've only insured for £5,000, and even if there's only £5,000 of damage, if there's 10,000 as a total stock value, the insurance company, that will be a 50% under insurance. So instead of paying the £5,000 that's damaged, they'll only give you £2,500. So that average clause, it really annoys people because they'll say, well, I had the cover, but actually the insurance companies or the loss adjusters will put those average clauses in there. Another one that we're seeing a lot at the moment is tractor values. The older tractors are actually going up in value. So on a tractor policy, it's only ever rated on the value. So those values need to be looked at, gone through carefully. A, if you haven't devalued them, you're paying a premium for them. But B, if the value's gone up on some of the specific models where they have considerably gone up, and you haven't got the correct insurance, if you have got an issue, and it is written off in normally it'll be a fire or an electrical fire in these older tractors, you just won't have the cover. So also at the moment, we're finding a hard market. It's the first time since 2001 that we've had actually a hard insurance market. So you will find that your actual insurance premiums are going up on an average about 10% across the book. So it is important, obviously, with all the other business costs are going up. If you do a review, insurance can be a major part of a major cost. So, as GRP, we're sponsoring the TFA, we're part of that, we're happy to do those reviews. We have Linda Davey at Marshall Woodridge does a lot of the reviews if it comes into that area, but we have businesses right across the UK that we can actually send people out and do the reviews if possible. It's not always possible, it depends where you are, in the country, but wherever possible, we will look at it, we'll come and do a review, come and see you face to face and sort it from there. But it's great to be part of the TFA. It's great to see what you do. I can't wait to actually can get out and we can come and see you face to face and meet some of the members and have some real live events. But for now, we'll have to make do with the on-screen version, which Mark is very good at hosting. So that I will leave it. I will pass on any questions, whether it's tonight or any other time. Just please let me know and we'll get through to answer them as soon as we can.
Brilliant, thanks, Debbie. I think you make some really pertinent points there, actually, about levels of cover. We've always got very used to older equipment just constantly going down in value. That's clearly not the case now, and I can certainly speak from experience on the diversification element. It's very easy to assume that what you're doing is sort of covered by your farm policy, and you may find that it isn't. So I would encourage people to just look carefully at that kind of thing. So I think you make some really good points there, Debbie, and thank you very much. And as Debbie says, if you've got any questions, please put them in the Q&A and we'll pick them up either at the end or with Debbie directly. So thank you very much, Debbie, for that.
Thank you.
So I think, again, without further ado, we'll move straight over to Adam, who, as I said, is the head of agriculture at Barclays Business. Barclays do sponsor our series of webinars, so please be nice to Adam. And we're very grateful for that, for the sponsorship that they give us and the support that they've shown to the TFA over a number of years now. So I'll pass over to Adam, and I'm sure this will raise some questions and hopefully provide us with lots of answers to get on with in the morning, Adam.
Absolutely, yes. Thanks, Mark. And yeah, it's a real honour to be involved in these events. And yeah, we really working with you, George, your members. This is a really important association for tenant farmers. And I'll touch on membership organisations in a little while as well. So yeah, so Mark gave an introduction. Mark gave an introduction. So I've worked for Barclays Agriculture for 8 years now, and I took over as head of agriculture in May this year. So I'm trying to position it as it's probably going to be the most exciting 5-year period in agriculture, and I've obviously landed at the right time as we transition to a number of different things. So the topic today is business planning in the new environment, and I think none of us can do that. None of us can think about what that means without touching on three really important topics. And the first is BPS, ELMS, or if you're in Wales, the Sustainable Farming Scheme. And what does that mean? What does it look like? How does it work? And the entitlements alongside that. Net zero by 2040. And if any of you have seen the NFU slides on net zero by 2040, there's a really sort of ambitious opportunity there. And I think there is a huge opportunity for UK agriculture to play a massive part in that net zero for the UK. And then thirdly, probably thinking a little bit further ahead, but automation and labour. And then I'll try and tie all of this up into the points that Mark covered around sort of our view of agriculture, the future, and sort of advice for how you go forward. So I think the first thing is the separation of the UK obviously means that there's different policies. So if you're in Wales, nothing will change until 2024, and obviously in the in England, that will start to move down up to 2024 before we move to ELMS. And I think the first important question to think about is, who does BPS benefit at the moment? UK spending on food as a share of overall expenditure is one of the lowest in the world. So does BPS benefit you as a farmer? Does it benefit producers? Does it benefit retailers? Does it benefit consumers? And you'll all have your own answers to that. And I think that's one of the unknowns that we don't know about the impact of the reduction in BPS. And I think that's where ELMS tries to really look at some of those public goods for public money schemes. And what I've seen over the last 6 to 8 months, and I'm sure Mark and George will have seen this as well, is there's a real focus on productivity in the sector. And I'm slightly biased. I have a real sort of favouritism for the tenanted sector. I'm out to see a tenanted farmer tomorrow. Is that I think you as farmers are some of the most productive in the UK, because you have to be. It's not a choice. It's not something that you can rely on your assets as it's growing. So I guess within that, we always talk about finance. I'm a banker. It's one of the things that I always seem to get drawn into. But there's a lot that supports the finance side of things. And one of the subjects I often talk about at these events is our kind of credit system that we use, and it's something called Campari. One of the first things we look at is character. We look at the ability, and then we start looking at the boring things like how much do you want to borrow and the purpose and how much it's going to cost. But character and ability are the first two things we look at. And I think skills, benchmarking, all of that goes into the character and ability of a farmer, and understanding inputs and outputs, working through different cycles, working through, particularly at the minute where fertiliser costs are, but also accepting that we've got some pretty strong, with the exception of the pig sector, some pretty strong commodity prices. And I think one of the great things that the government has come out with, particularly in the UK, and I know there's separate schemes in Wales, is the Sustainable Finance Farming Initiative, and that's support at zero cost. So you can get some support, you can get somebody out to come and have a look and give some advice. And those kind of schemes can help. And I would advise anybody, it would be my first advice, anything that's free, get a hold of it and use it or lose it. There's an opportunity to do something with it there. But engaging with industry bodies, particularly as we go through the period of change, such as the TFA, is probably more important now than it's ever been. And for all of it, it's staying close to understanding what's happening, what's changing, what's going on, what's the latest. I think all over social media, all over the media yesterday was the news around some of the grant schemes that have come out to support with sustainable farming, and understanding what they are, getting in early, understanding what the process is so important. But the question that we all ask, and I ask this all the time, is how is ELMS going to work? So if you're in England and you're transitioning in 2025 over to ELMS, or if you're in the pilot scheme sooner, what does it mean? How does it work? And I think that's one of the challenges for us as a bank and me as the head of agriculture is understanding what does it look like? And it's not as black and white as it used to be. And I think that's one of the challenges with the whole net zero piece for all of us. So if you look on the government website in England, there is some guidance, and there's lots of words: soil, woodland, grassland, water management. And I guess this all then leads into the second part where it ties into the net zero ambition for 2040. So as I said at the start, agriculture is the only UK sector which can act as a carbon sink. So there is no other sector in the UK that can actually be negatively net zero, or whatever the word is that you want to call it. And I think the challenge all of you will be wrestling with, and we wrestle with, is how do you measure carbon? And I have probably been on, I'd say probably about 25 different calls where people have shared with me carbon measurement systems, different ways of measuring things. And there's lots of tools out there. I was on a call with UK Finance recently, and I think they told me there's over 100 different carbon calculators across the farming sector. And I think what we need to move away from, and the thing that we all enjoy, is having a number to pin things to. And if I'm honest, I think if we wait for that number, it could take a decade to get the right number and understand what the right number is. But what we can do now, and what all of us can do, is start to take actions. But the challenge with net zero and the challenge with looking at ELMS is there's no silver bullet. There's no one solution that's going to suddenly make your farm net zero or change the way that you do things overnight. It's going to be a fairly long process. And it may mean there's lots of different routes to doing that. Could be productive land changes, could be soil management, and I've been on a number of calls where farmers are particularly doing that. It could be the way that you manage grassland, livestock productivity, if you're considering how to reduce methane. I heard a fantastic farmer at a conference yesterday talk about what he's doing with unproductive livestock. It could be slurry management, and I know that's a big topic in Wales. And I think this is where ELMS can support, because these are things that farmers will already be doing. And I think as long as that's recognised in the scheme, it plays a massive part. One of the questions that was asked before the session was about forestry, and my view is forestry and rewilding can play a part, but we shouldn't be replacing productive land with forestry. That's not the answer. We shouldn't just be covering the whole country in trees. And a number of conversations, I don't think anybody's suggesting that. So it can play a part. But I think the other challenge is, and this is where all of us need to understand and stay connected to what's going on, is there's now an additionality clause when you're looking at forestry. So there is carbon credit markets, they're voluntary carbon credits, and there are a number of corporates that want to buy them. Microsoft are one of the biggest buyers of carbon credits across the world. But you can only apply for those carbon credits with woodland if you wouldn't have planted it without that incentive. And that's where the additionality piece comes in. So it just goes to show this topic is so complicated that it becomes really hard to maneuver. And I think that's where talking to other farmers, talking to the TFA, talking to your bank, talking to anybody that you can, really, just to get an idea of what they're doing and what they're trying to do. So there's probably more questions there than there is answers, but I think that's the position we're in at the minute. And I think what you need to be considering today is have you got advice, have you got support, have you had some guidance in terms of what you can be doing to get to net zero, because that will tie in with what the ELMS schemes mean, but also understanding what action you can be taking over the next 5 to 10 years. And some of it will be long burn stuff, but it doesn't mean replacing productive farmland. That is not the answer. So I think the other piece, and we talk about costs, and day-to-day costs is something that you're certainly experts at managing, and I'm certainly not going to sit here tonight and talk about that. But I think it's one of the buzzwords that seems to be around the sector a lot, and perhaps doesn't mean a huge amount, is agri-tech. And I guess it's just thinking about over the next 3, 5, 10 years, what does that mean to farming, and how can it help increase productivity? So lots of farms I know will exclude labour as a cost, particularly if you're using family labour. But I think it's really important to start looking at as a cost, and particularly if you're on a farm where you're having to employ non-family labour. And you're probably finding it slightly difficult at the moment in some areas of the country, as every other business sector in the UK is at the moment. And agri-tech is really quite simple. It's where you can use technology that's new to do something that effectively a person used to do. So, for example, I think one of the sort of upcoming opportunities is strawberry picking. It's obviously a very laborious task. It's very labour intensive. You've got very short windows in which to do that. And there are machines that are nearly commercially available that will be able to do that in quick periods as you need to do the strawberry harvesting. I spoke to a potato farmer a few weeks ago, and he was considering an optical potato grader. And I think the cost was something like £70,000. And he'd worked out that actually over the course of the sort of 4-year period, it would pay for itself, because he was employing 2 people to do that manually. He was only getting one occasionally at the moment because he wasn't able to get the two that he was asking for. And the numbers make absolute sense. And I think that's where, as an industry, we need to start thinking about some of these things and how do they commercially impact. And I think the carbon credits market will develop. It could be an opportunity, but there are certainly productivity gains that can be made from some of the environmental measures if we take it away from just planting more trees, which is definitely not the answer. The technology side of things can help with productivity. It can help with your own real personal time. And I think the robotics in the dairy sector has really shown how that takes away the kind of sort of morning milking and afternoon milking. So one of my asks really, and I know we're going to try and open a session up on the TFA website for some questions that have come up today. But if you've got any thoughts today, I'd really be keen to hear from any of you about how do we connect farmers with technology. We recently opened our Agri-Tech Lab at the University of Lincoln. So it's a Barclays Agri-Technology unit. We've got lots of kind of interesting startups coming in there and coming up with ideas and starting to bring those to sort of commerciality. It generally tends to be sort of techie people and academics, which when you try and put them in front of a group of farmers, it doesn't really work. So I'm really keen to hear from any of you if you've got any ideas around how we can start getting some of that in front of you, start helping you to make sense of it, seeing where the commercial opportunities are. And I'm keen to understand, how we bring those two worlds together, because I think that's going to be really important for us over the next 3 or 4 years. So I guess in summary, I think about what new skills do you need in this new world? So if you reflect on your business today, do you have the skills to understand technology that's emerging? Do you have the skills to understand the environmental changes and how that will present an opportunity for you? Or simply, could it be that you just need to look at in terms of metrics, financing and benchmarking? And how can you obtain that support in your business? Because if I go back to that model that we use, we always look at C and A, character and ability first. And that's a key measure for us when we're looking at any farm. It doesn't matter whether we're in a down period, whether we're in an up period. It's always looking at that. How can that farmer go and deliver and have a proven track record of doing that and stay current? And I think that's the most important thing. There is tons of support out there, particularly at the moment. And I think that the Tenants Farmer Association are a fantastic source of support, and these kind of sessions really help in terms of raising questions and giving people ideas. But there is various schemes out there in Wales, in England, that you can gain access to that are free at the moment. There's various grants out there that you consider for technology and productivity. And also your bank is there. So if there's something that you want to talk about, if you've got an idea, you think, does this work? My managers across the country, and there's over 100 of them, they will talk to lots and lots and lots of different farmers every day, and they will know all of the things that they've tried, what hasn't worked, what has worked, what was pie in the sky, what was actually a kind of secret that nobody shared with everybody. We tend to get a lot of in this sector. But it's talking to as many people as you possibly can and really just taking those skills into your farm, which is going to help us navigate the next 2 or 3 years, because I don't think we're going to be in a position in the next 6 months to have all of the answers in black and white. And if I'm honest, my learn over the last 2 years really is it's going to be very, very hard to achieve that when you're looking at net zero and BPS. So I think I've probably run short, but I'm conscious we've got lots of questions, Mark, and I think there was quite a few questions beforehand. I'm always keen to sort of cover any that people have or any that you have today. So I shall leave it there, or else I could go on for probably 3 weeks talking about those subjects, but let's focus on what we know.
Thanks very much, Adam. Yeah, I think we're trying to cover quite a lot of there's quite a lot of issues around how we plan in the current environment. I think the one thing you have kind of hit the nail on the head is that it's going to be some time before we've got the full picture as to how ELMS and other support schemes really impact us. But I don't think that should be an excuse for putting your head in the sand and saying, well, I'll wait until it all comes out into the open and then I'll know how it all works. I think it's if anything, it's more important to use the advice and knowledge of people in the short term and keep an eye on what is going on to try and help your business through stuff. So I think if it's okay, Adam, we'll just my series of questions might be a little bit random in terms of any kind of continuity with them, because we've had quite a number There's a few being posted on the Q&A now, and there's quite a number of ones that you've seen pre-event. So I'm going to just jump in with what every banker gets asked, which actually, and I'm going to add something to it from a member in Somerset, as what are your views on the likely interest rates in the foreseeable future? And I might just add to that is, should we, if we're looking to invest in our businesses with machinery or capital purchases, actually, should we be doing that double quick before interest rates rise in order to take advantage of what is relatively cheap money still? Two slightly connected questions.
So I'll give you a short answer, then I'll give you a longer answer, because I do get often asked this. And yeah, if I knew where interest rates were going, although they haven't gone very far in the last few years, then I think I'd be a millionaire. But it's interesting because I think there was a lot of media noise around the proposed increase a few weeks ago at the Bank of England. And actually, when you think about it, it was going to go from 0.1 to 0.25, which is still historically low, and it has been historically low for a long time. So I think the answer, that the reason that is all becoming sort of to the fore at the minute, and people are sort of predicting where interest rates are going, and markets are considering that, is you've got to go back to COVID. So all of a sudden, and we're seeing this all across agriculture, we're seeing it across other sectors, all of a sudden, on the 23rd of March, spending on everything but Netflix and Amazon stopped overnight. And suddenly you've got this, at the end of that, we all came out and said, actually, I'm going to go on holiday, or I'm going to buy a car I haven't driven for 18 months, or I'm going to buy a new piece of machinery. And we haven't been producing it for 18 months because we'd all been into lockdown. And what we've seen over the last few months as we've started to come out of lockdown in other countries across the world is you suddenly see demand switch from services and goods, and nobody wants to watch Netflix or Amazon anymore, and suddenly go back into goods, and people going out and buying things and buying experiences. And inevitably, because of the lockdown, there's a real shortage of those goods. So supply and demand, if any of you have ever remember sort of GCSE economics or maths, it always goes in the wrong direction, prices go up. And I think what we're seeing at the minute is that the Bank of England are trying to work out, is that temporary? So will we see in the next 3 or 4 months that suddenly loads of businesses are putting extra resource into creating these because they know prices are high? And if you think, we touched on machinery at the start, but delays on machinery, on new cars, on pretty much anything is sort of 10 to 12 months at the minute, which is unheard of. So will that quickly go back? And in which case we go back to a sort of low inflationary environment, or will it continue? And that's the bit I think the Bank of England are struggling with, and that's why we've got so much noise around interest rates. But I think they are historically low, that even at the forecasts that the sort of the markets are suggesting, which is that rates could possibly go up to 1%. In the grand scheme of things, that's still historically low. And for those of you who remember Black Monday, when we went up to 13%, and the days when you used to get 6 or 7% on your savings, it's still an incredibly low time. So if you're concerned about rates going up, there is the option to fix, and fixed rates are still relatively low at the minute. So you've got that security. You could consider doing part and part if you want to kind of play across it. But I think if money is where it is today, and even if it goes up to 1%, it's still incredibly low. It's still, if you can get a higher return than that sort of 1% that's available at the bank, then do consider. And I think there are some opportunities to do that.
Okay, thank you. That's certainly interesting, Adam. I think because I suspect we're all sort of panicking at the thought of interest rates going up, but as you say, they're historically low, and some of us are old enough to remember things that are a lot higher than 0.5% and closer to double figures, obviously. So we perhaps need to keep perspective, I think, is what you're saying there.
Absolutely.
I'll move on to a little bit about elms in particular. So we've got a previous question from Devon, just asking, DEFRA hasn't yet come forward with its kind of a fully developed environment land management scheme. There's no sign that food security is on the radar of the government. I wonder whether does that make Barclays slightly concerned about continuing to support the agriculture sector with the lack of detail, and particularly tenants who almost by default have less collateral than landowners? I just wonder where the overall bank's attitude is to that and what impact that's having in the short to medium term.
Absolutely. Yeah. So it feels like we've gone from sort of crisis to crisis over the last 7 years. I think I remember this conversation would have been about Brexit, and I remember the days just before we got a deal, and it was like, what does that mean? And throughout that whole period, we continued to support the sector as we have done, certainly for the last sort of 200 years. So I think what our understanding is the commitment from the English government is that funding will stay at the same rates. It will just be different. And I think we all accept that that's probably going to be a different split to what it is now, because it's not going to be a simple payment for some land area. But I think if you're a progressive farmer and you do well and you can afford to borrow and you can afford to repay it, then I think those farmers have got best opportunities under Elms to take advantage of those schemes and to really make them work for them. So my view, the bank's view, our sort of risk view on agriculture is no different from what it was really before Brexit. It's stayed exactly the same, and I think we're confident that whatever happens, farmers will adapt to it. And I've said this, so there's an article, and you can quote me, there's an article on the Barclays website where we talk about this. If you took a farmer and put them in, some swanky building in City Road in London, they'd probably be running Facebook or something like that. These are people, and every farmer I go out to see, they're mechanics, they're scientists, they're financial people, they're entrepreneurs, and it's that character and ability again, which is what we're looking for. We know there are people in this sector who will, go on and progress and do things and really grow their farms. And there will be others that won't. There will be people that say, actually, I've been doing it for a long time, and I think the government's recognised that with the exit schemes, and said, look, if it's not something that you fancy doing, then there is an opportunity to get out. I'm not sure it works in the way that they intended it to, but I think the people that do remain, and that will be the majority of farmers, I've got no concerns at all.
Okay, well that's definitely good to hear, and I guess
I'm an eternal optimist, though, Mark, so
I think we all have to be eternal optimists, Adam, in this environment. So I am going to I think there's a couple of sort of connected questions here. There's one just come through on the chat from it's actually an anonymous attendee, but it's just saying, so as a young farmer trying to get into the industry, what are your key tips to a startup loan from Barclays? And perhaps I could just add to that, Adam, you've concentrated on, or you've mentioned a few times, that the bank would always look at character and ability in terms of that. And that, on the one hand, is very good to hear. On the other hand, I think there would be a concern, I think, probably from our members and from the tenanted sector a little bit, that there must be a point at which you look at character ability, you look at the enthusiasm, you look at maybe the guy or lady that's asked the question here and think, yeah, that'd be really good. But unfortunately, they've been offered a 3-year FBT, so they don't have any sustainability in their business. So how does the bank balance those up? And maybe I could add another question to that, which is, how does the bank try to influence people to give longer tenancies, because that is clearly the answer?
Okay, well, I think to the question around trying to get into the industry, I think it's no different from really any other industry in some ways. So if somebody walked into a bank today and said, I'd like to start a shop up, so I'd like to borrow £50,000 because I need it for fittings and I need it for cash flow, the first question we'd ask is, well, okay, so what have you done in retail? So tell us through your experience. And I think that's one of the things that I've seen, particularly in this sector, is that getting, whether it be getting an education at an agricultural college or going directly into a farm and really learning from somebody who's doing it. And when you get to the point where you go, actually, I could do that better, or they're doing that wrong, then that's the opportunity, that you've really sort of developed your skills. And I think that's such an important part of it. I don't think anybody can just walk out of college or, walk out of another industry and come into agriculture. I think you've really got to learn the ropes first. And you can see that in succession. So I think my first advice would be, go and get some experience, go and consider what your opportunities are, and start with something that, like you say, it might be a short 3-year FBT, it might be on a small piece of land, and sort of set yourself a plan for how you develop that into something bigger when opportunities come up, if they come up. If you're looking at, potentially purchasing a small parcel of land, that's where the bank can help. And I think that the point around the kind of shorter tenancy is that, from a cash flow perspective, we'll look at it on an annual basis, and that's typically where we lend to the tenant farmers, because they're not buying land. So machinery works quite simple, because you just borrow against the machinery, and if it's cash flow, we'll look at the sort of value of stock and everything else, and work out what your peaks and troughs are and how we can help you through that. And if the FBT ends, then obviously everything will kind of get repaid and go from there, and there might be bigger opportunities. But I think one of the things that George and I talked about recently was there's a lot of focus on new entrants and support for new entrants into the sector, and I know this is something George is very passionate around, but it's almost like, but where do those new entrants go? And I think that's the challenge, is if there's nothing bigger or there's nothing available, and so with county council farms, some of them across the country being sold up, it's how do you get bigger if you want to get bigger? And I think that's certainly the biggest challenge for tenant farmers, is making that move. I'm not sure I know the answer, Mark, on the longer tenancies one. I know you and George do a fantastic job of really sort of appealing to government for that and lobbying for that. I think when Elms comes in, I think that's an opportunity to perhaps push it even further, because if you're going to be taking environmental measures, they do take 5 or 10 years, and it could be, it's going to restrict that if you've got short tenancies. Because why would you go and plant trees that are going to take 3 or 4 years to suddenly become sort of carbon sinks if you've only got a 3-year tenancy? So I think there's an opportunity to revisit that there, and it's certainly something that security is something that we talk about with DEFRA and the bodies that we talk to across the UK.
Thanks again, Adam. It sounds like you were in the meeting that George and I were at with Victoria Prentice on Monday with your last statement there, because you could have taken the words straight out of our mouths there. That's exactly what we said, that Elms is a great opportunity for them to step in and encourage longer term tenancy, because but I think, on seriously, I think you're absolutely right, that the environment changes from a very simple annual BPS scheme to a much more complex multi-annual scheme, and that should encourage people to let land for longer periods. And this is a real opportunity to push that message a bit harder, really. As I say, I'm jumping around a bit with questions here, and I'm going to just jump onto one that I might also ask George to comment on after you've said your piece, Adam. And I'm going to put 2 questions together here. So a member in Lancashire is asking, where a tenant gets the opportunity to purchase the freehold of the property, what level of discount from the vacant possession price does the bank usually consider appropriate before it would lend money for the purchase? And kind of not entirely disconnected to that, but under what circumstances would you advise a client of the bank to consider taking the BPS lump sum exit scheme, obviously only available in England? So kind of vaguely connected, but I'll ask the 2 together. Yeah. And George, I don't know if you would just come and add a sort of specific TFA answer to those 2 as well.
This is a test then. Do I get the right answer? Because George will, yeah. So, so I think on a vacant possession basis, so we discount the value of the land to a degree anyway when we do valuations. I did know I was getting this question, so I did ask a couple of my relationship managers, and I think the figures that they see are typically around sort of 30%. He did say to me that the tenant had really pushed back and was trying to get it much lower, but I think we'll typically see the discount around 30%. But the discount shouldn't dissuade you from talking to us, because we will look at the value of the land as it is on a vacant possession, and we'll look at how we can make that work for you. We can look at anything that you've already got invested in there and try and make up any sort of cash shortfall. So I guess if you get the opportunity, then talk to us, or talk to your own bank. It doesn't have to be Barclays, but talk to any bank, because I think there are ways that we can work around it. But the figures I've been given are around sort of 30%. I think the lump sum exit scheme. So firstly, we wouldn't get into advising, because that's not our place to do that. I think the kind of guidance we would say is succession is a big one, I think, here, and if you haven't got the opportunity within the family, within the business for succession, is to consider, well, what is that succession plan, and is now a good time to perhaps use that scheme that they've got in England to consider. You've got a pension, you can go and do something and move away from the farm rather than just keeping it and keeping it going. So I think that's the examples of where I've seen some of our customers have decided to take it up. But it's not for everybody. I think it does fit a very, very small niche. But I'm sure George will have an opinion of how his views on that.
Could I? Sorry, before George comes in, Adam, could I just ask, just out of interest, are you finding that you have clients coming in already discussing whether going into the lump sum scheme might be a sensible option for them, or is that not something they're really opening discussions with you about?
Not really. It tends to be the very, very small farms. So, and I think particularly in some of the sort of upland areas where you've perhaps got very, very small herds, and you've perhaps got, so I'm being typical here, but perhaps, two people, couple in their 60s, no children, thinking, actually, I really enjoy doing this, but there's an opportunity here to take the money and move the farm into something else. Somebody else will come and pick that up and give somebody else an opportunity, because nobody in the family wants to do it anymore. And it's typically those types. I don't think we've got big landowners coming in at the minute going, actually, here's a chance to get some money. But I think there is perhaps an opportunity for tenants in that, because I think there inevitably will be some landowners who go, actually, it's not for me anymore. I'll keep the land. I'll perhaps take this and use it as an opportunity. But I'll be honest, we've had a very small number of conversations that I'm aware of. So,
yeah, interesting. George, did you want to just come and put a bit of a spin on both of those two?
Yeah, thanks, Mark. So turning to the issue of a tenant having the opportunity to purchase the freehold of the holding. Now, we're talking here in terms of rules of thumb here, because obviously it will very much depend on the individual circumstances of each case. So you might have a holding that is pretty decrepit, where the landlord's got to spend a lot of money to bring that up to spec, and might be willing to get shot of it for a lower price. And you might find a landlord who's got a holding that's well maintained, well invested, and able to be used readily. So these are rules of thumb and orders of magnitude. So in most cases, if you are occupying as a tenant with an AHA agreement for a lifetime or a 3-generational succession, you will be depressing the freehold value of that land by around half. So if it was worth, let's say, £12,000 an acre, the fact that there is a sitting tenant on there will mean its open market value is more like £6,000 per acre, because you're depressing the vacant possession value of that ground. When you try to do a deal with a landlord on a purchase, what you normally try and aim for is that sweet spot where you are sharing what's called the vacant possession premium with the landlord. So the landlord knows he can get $6,000 an acre for it if he sells it in the open market today. He knows the vacant possession premium's 12. He might say, well, let's share that £6,000 uplift per acre between us. So you get $3,000, we get $3,000 per acre. So the price paid by the tenant is £9,000 per acre, as opposed to a £12,000 a vacant possession value. So it's trying to find where that sweet spot is to ensure that you are getting a good deal in terms of the vacant possession value, but also that the landlord is taking some value as well in terms of what they can achieve. So Adam's figure of 30% is about right in terms of where you might end up in terms of the deal with the landlord, and that's where you've really got to be aiming. As far as the lump sum exit scheme is concerned, we think that there are 3 scenarios where it could be really valuable. The first is in those situations where farm businesses have already got a potential successor lined up, and where that successor could take on the business, with the retiring tenant leaving the business into the hands of that individual, and the retiring tenant being able to take the lump sum exit scheme as a way to help that succession go forward. Obviously, the successor's got to realize that they're going to lose the BPS payments immediately if that's the case, but in certain circumstances that could work. Secondly, in situations where we know that members are already in advanced discussions with their landlords about a potential surrender of the tenancy, where the landlord's willing to put in a bit of money to buy back the tenancy, and where that previously hasn't been enough on its own, but the lump sum exit scheme in addition could just make the difference between a deal or no deal. However, I must say that we are very concerned that there are land agents out and about at the moment attempting to snaffle the value of the lump sum exit scheme by reducing their offers to tenants for surrenders. So previous figures given are now being reduced by landlords because of the availability of the lump sum exit scheme. So we want to hear if anybody is experiencing that, because we are trying to root those situations out. And the third scenario is where for small owner occupiers who might want to exit the industry because they haven't got a successor, but the ability within the scheme to rent the land out to another individual and retain the ownership of the land, but still be eligible for the exit scheme is in our view a really good thing, because we might be able to get some of those new entrants we were talking about earlier, and providing opportunities for progression as well. So, and the other final comment I'll make, Mark, is that for some people, it may not be the lump sum exit scheme that's the thing to go for. It may be the delinking of the payment that will be the thing to go for, because what the government is saying is that the payment can be receivable even if you don't farm the land. So you could be receiving a payment for a longer period of time without having necessarily to farm the land. So we need to look at how delinking fits with this. And for our members and viewers in Wales, we are lobbying the Welsh Government to come forward with a similar scheme. At the moment, it's very early days. As Adam said, we're not expecting change until 2024. We're currently in discussions with Welsh Government about the Welsh Agriculture Bill, and certainly as part of our lobbying, we are looking at options for lump sum.
Thanks, George. Yeah, and I'll just remind everybody on here, we will be probably doing one of these webinars in the new year around the lump sum scheme when we hope to know a little bit more. And well done, Adam. You were pretty much on the nose with your 30%. So big tick. Well done. No, that's good stuff. I'm gonna just move on a little bit. You mentioned net zero quite a bit early on, but I'm just gonna jump in quickly with one question, sort of do this slightly in reverse order while we've got George on the screen. Christopher Davis asks around carbon credits, and I'll come on, Adam, just to ask a few questions around financing that in a moment. But Christopher Davis asks, who will own the carbon credit, the tenant or the landlord? I think this is probably one for George to clear up for us.
Thanks, Mark. Make the most of me while I'm on screen. Absolutely. This is a really important question, and it is a question that we are facing every day of the week now, as we see the interest in carbon credits and net zero ramp up. If Christopher is interested, we have a webinar that's already on our YouTube channel that we did a few months ago with Charles Callop of Harper Adams and Philip Mead, where we looked at issues around biodiversity net gain and carbon credits in a full hour. So I would recommend that Christopher goes and looks at that. But the short answer is it depends on what's in your tenancy agreement. And obviously the most potent store of carbon and sequestrator of carbon that the government's talking about are trees. Trees have traditionally been in the purview of the landlord, but increasingly we're seeing new and innovative agreements coming through with farm business tenancies, looking at how tenants can take part in tree planting, particularly on field edges, scrubby corners, wet corners, and agroforestry as a means to sequester carbon through trees. But also we're looking at the soil. The soil is a very important store and sequestrator of carbon, particularly when you're putting in organic matter to that, hedgerows themselves, and your grasslands. So it's really important to make sure that when you are signing up to new FBT agreements, particularly, that you have them checked to make sure that you're not giving away the carbon credits to the landlord in the way that those agreements are written. I suspect that the older agreements will not be covering carbon as an issue. So there's a moot point as to who owns those credits. So there is the opportunity for both landlords and tenants to be able to capitalize on that but it really comes down to what's written in your tenancy agreement. So do look into those quite carefully.
Thanks, George. Yeah, and thanks for the reminder about the previous hour session we had earlier in the year. That was really useful, actually. I think from worth a watch to anybody who wants to take a look at that. Just Adam, just bringing sort of us back a little bit to net zero. I'm going to just throw a few questions at you in a sort of a mixed order, really, I guess. Obviously, you've mentioned I guess the opportunity that net zero possibly provides agriculture, but I think that probably needs to be caveated by the fact that we're in a little bit of a wild west at the moment about carbon credits and so on. And one of our members, Michael Summers, asked that given the financial challenges that lie ahead, do you think that the NFU's aspiration for net zero a decade ahead of the government, it could in fact be an expensive own goal? So I'll just let you think about that, and I'm sure Michael isn't wishing to have a pop at the NFU or anything on that one. So I'll just let you think about that for a moment. The other thing is, there's been a lot of talk within DEFRA circles about blended finance and private-public partnerships. I wonder what attitude the bank has and what criteria they would look at if someone was coming to them as a private business and wanting to buy carbon credits and finance that purchase somehow. How would the bank evaluate that as a way of us as tenants or farmers leveraging in some of that private money? So there's two sort of things. Are we being pushed to try and achieve net zero too early? And is that going to be very expensive? And secondly, should we be, and how would the bank look at getting private money into funding things towards net zero?
Okay, so I'll start with the last question, and it'll give me time to think about Michael's question as well, hopefully. So, I think just to build on George's point, the thing to think about with carbon credits and carbon markets at the minute is that there's not some bourse in Switzerland that deals exclusively in carbon credits. The markets as they are today, they're voluntary. So it's effectively you and I, Michael, could agree, actually, your farmland is, I believe that somebody's telling me, a third party's telling me that that's capturing carbon. Therefore, I'd like to buy that off you because I'm flying lots of jets and I'm taking up lots of carbon. So it's a voluntary market. It's not a regulated market. They tried that in the EU a few years ago, and that's kind of changed. So I think it's hard to finance something that's voluntary because it's not fully regulated, and I think that's where we will progress to over the next 5 or 10 years. I think that will certainly move in that direction, because inevitably you're going to have 5 or 6 different voluntary schemes, and there'll be something that comes out of there that doesn't work, and unintended consequences. So at this stage, I think it would be quite difficult to finance the purchase of carbon credits. But I don't think there's any shortage of buyers. It kind of ties in, and let's start building on to Michael's point, is that actually this, and I keep reminding people this every single day, this is the only sector that can sequester more carbon than it produces. If you're in the oil industry, all you do is produce carbon. If you're in the aviation industry, all you do is produce carbon. You can't stick solar panels on planes or reduce the amount of oil that you're taking out of the planet. And it's that's where I think this sector has got a great opportunity, and that's why I think the NFU's aspiration, actually at 2040, I think we could probably be there by 2030. I think 2040 is quite conservative because it's going to be much harder to get there if you're into aviation. Reducing your carbon footprint by 2050. So I would advise anybody just to have a look at the detail on the NFU's pack. It's 4 or 5 slides, and I had to explain it to somebody the other day, so I read it in full. And it's really interesting when you look at the current carbon that's produced, and that includes methane and greenhouse gas emissions, and the opportunity over the next 19 years to offset that, which is all you need to do to get to net zero. So you can reduce some, and then you can offset some by doing more. 65%, well, it was 2 years ago, 65% of renewable energy in the UK is produced on farms. And I know that's differently managed in different ways, but that's something that the sector does and can be offset. But it's understanding, and a farmer said to me the other day, he goes, I've got solar panels all over the shed. And I said, so do you use it to power your buildings? And he said, no, I sell it, but I can also get, net zero for it. It's like, you can't sell it and get net zero. It's one or the other. You have to offset it, or you get paid for it. And it's understanding those kind of things. So there will be things that that farmers can do that will take longer, and it will be those types of things. One of the quickest things you can do is switch to a renewable energy supplier. That reduces your emissions straight away because you're going straight onto renewable energy. There will be things that you can do in livestock. There will be different ways that you can manage in terms of grassland and potentially trees. But grass, again, and hedgerows are some of the biggest captures of carbon in the UK. And it's about how do you use those. So actually, I think 2040 is not particularly ambitious for the sector. I think it's got a great opportunity. And I think the NFU's ambition is 2050. Once we've got a mature carbon market, actually, there will be a lot of farmers across the UK who can go, actually, I'm sequestering more than I'm producing. How do I then make money off of that and build on the other schemes that are supporting me? So that's, again, but Michael, that's my optimistic view. So who knows? You can check in 19 years. I might be wrong.
Thanks, Adam. No, well, I mean, I think you make a good point that we are an industry which does have that opportunity, and other industries perhaps don't. Which, I mean, what is Barclays doing as a business to become net zero? And are you encouraged to look at projects that are environmentally friendly and sustainable rather than buying a private jet or something?
Yeah, absolutely. So we've got a 2050 plan for how we as a business, and I think the challenge for us is it's not just about converting our electricity. Our role is financing the transition, and that's quite a hard balance because you can't suddenly stop lending to businesses that produce carbon, because if you do that, then how do they transition to something new? So we've got some really interesting tools on our website. One of them is called Blue Track, and it just tracks how much emissions that we finance in particular sectors. So I think it focuses on energy and aviation, and it looks at how are we reducing that over time as those businesses are making changes or offsetting what they're doing. And it really just tracks what our goal is to 2050. So all of our financing agreements are in line with the Paris agreement. So it's really clear on the website, but it's not something you can just stop overnight. That's not a responsible way of doing it.
No. Okay, thanks very much, Adam. I'm really conscious of time. I've run over as ever, and I've failed to ask, sorry, about half of the questions that have been posed. I'm going to just fire one very quick. This is a yes or no, I think, answer. Somebody's asked, should we be paying back our bounce back loan early, or take the 2.5% fix as a good deal going forward?
2.5% fixed is a very good rate. So I would say if you can afford the repayments and it's not an issue, then you can use the money for something else, then go and invest it somewhere else and earn more than that 2.5%. But if you want to pay it back and it makes you feel better and you don't like having it around, then do it. It's a personal decision, absolutely. As a politician's answer. That's a very
thorough answer, Adam. That's a very thorough answer, covering all the angles. Very good, thank you. So yeah, I'm a bit conscious of time. We've slightly run over, and as I said before, I'm always conscious that there's a limited time when people can concentrate on a screen, and an hour is about right, probably slightly less. So I think first of all, just a big thank you to Adam for answering so many questions and giving us a thorough overview of really a massive range of topics. It's been really useful, Adam. Thank you very much. A lot of food for thought in there. And also to Debbie from GRP, I think a bit more food for thought on that one as well. Certainly, obviously another cost that's going up. I think we're getting used to costs going up here, not unreasonably, but I think the pertinent point that you made, Debbie, which I do think we need to look at is the cover enough? And your example of grain is pretty pertinent given the prices of grain at the moment. So I think that's thank you very much for that contribution as well. Really, really valuable. So thank you very much to both Adam and Debbie, and of course, as ever, to George for answering one or two of those questions as well. Just as I close, a reminder that this has been recorded. So if you want to point anybody in the direction to listen again or whatever, look on our YouTube channel or on the website. Reminder of future events coming up. We've got one next week, which is a members virtual surgery. on finding and applying for a tenancy. We've got one of our expert speaker, Caroline Squires, one of our TFA advisors, be hosted by George as ever, and please register for this. There are a few places left, and this one is starting at 2 p.m. George, am I right? I think, yeah, 2 p.m. So this is an afternoon session, so you don't have to miss Coronation Street or whatever you watch to attend that. So please book in with Julia on that. And our next webinar event is on the 8th of December, which is open to everybody, and it's DEFRA, Janet Hughes from DEFRA, on the future farming policy update and what it means for you. You'll remember Janet came and spoke to us in July, which I think was a useful webinar, and we're expecting quite a lot of announcements between now and the 8th of December. So she should have quite a lot to tell us, and we should have quite a lot to ask her, I expect. And we will continue running these through 2022. So, and there's that, just keep an eye on the website or the newsletter for what those future ones are. So once again, massive thanks to Adam and Debbie for coming along tonight and giving up your time. Much appreciated. Thanks to everybody who's attended. Hope it's been useful, and enjoy the rest of your evening.